All right, let's unravel the DNA of sound value investing. It's like the secret sauce behind successful investors.
First up, we've got time. Value investing isn't a sprint, it's a marathon. This means giving your investments the luxury of time to mature and letting the magic of compounding work its charm. Warren Buffett, the sage of Omaha, is the poster child for this. He purchased Berkshire Hathaway shares at $7.60 US in 1962. And as of the end of 2023, the Class A shares were dancing around $540,100 each. Talk about the power of patience. Next on the list is temperament, your ability to manage your impulses and giving in to collective emotions in the world of investing. It's about keeping a cool head when the market throws its tantrums. Sir John Templeton, a legendary investor, once said, "The time of maximum pessimism is the best time to buy." Embracing this mindset, you can turn market downturns into shopping sprees for undervalued stocks. Now, let's talk about truth seeking. This is all about diving deep into a company's fundamentals, separating the wheat from the chaff. Charlie Munger, Warren Buffett's right-hand man, once said, "All I want to know is where I'm going to die, so I'll never go there." It's a metaphor for avoiding pitfalls by seeking the truth about a company's health and potential while making sound investment decisions. Applying these characteristics means having the discipline to wait, the resilience to weather storms, and the diligence to dig into financial truths. Picture this. You identify a company trading below its intrinsic value. You patiently hold through market fluctuations, and over time, watch it grow into a prosperous investment. That is the art of value investing, a blend of time, temperament, and truth-seeking that can turn a portfolio into a wealth-generating machine.
All right, let's dive into the continuous learning approach to value investing. It's a crucial element that separates the wizards from the wannabes.
Firstly, there's the time you invest in studying companies. It's like prepping for a journey. The more you know about your destination, the better your experience will be when you get there. Warren Buffett, the Oracle of Omaha, is the epitome of this. He spent hours delving into annual reports, understanding businesses from the inside out. Then comes the patience to allow your investments to grow. Take Buffett's investment in Coca-Cola as an example. In 1988, he bought shares for $1 billion. Fast forward to today, and that investment has snowballed into a fizzy fortune. Now, we can't forget the time to allow prices to reflect value. It's like waiting for the perfect sale. You want to buy when prices are steel. Buffett's investment in American Express during the Salad Oil scandal in the 1960s is a classic case. The market panicked, dropping the stock, and Buffett swooped in. As the dust settled, the stock rebounded, turning his patience into profit.
Applying the concept of time means dedicating yourself to learning, having the patience to let your investments blossom, and the wisdom to wait for opportune moments. It's not about clock watching, understanding that time is the secret sauce for the recipe for successful value investing. So, grab your magnifying glass, settle into the long game, and let time work its magic on your portfolio. All right, let's unpack the artful concept of temperament to buy, hold, and sell when necessary in the realm of value investing. So, what's this temperament all about? Well, it's the emotional compass that keeps an investor grounded in the face of market whims. Used in value investing, it's the patience to buy when prices are favorable, the discipline to hold onto quality stocks for the long term, and the wisdom to sell when the fundamental landscape changes.
Picture this. You're eyeing a stock that people seem to be piling into. The impulse to buy kicks in, but you resist that impulse to chase a market's fleeting excitement and make a well-reasoned purchase only after completing a reasonable assessment of the company's fundamentals and risks. Only then do you buy, but you buy below your assessment of the company's intrinsic value. Now, the temperament to hold comes into play. It's the resilience to weather market storms, ignoring short-term noise and focusing on the company's intrinsic worth. Warren Buffett, the grandmaster of value investing, epitomizes this. He held on to Apple during market hiccups, returning 615% as of the end of 2023 on his initial investment. And finally, you need the temperament to sell when necessary. It's not clinging to sinking ships. When a stock's fundamentals erode, having the courage to sell prevents further losses. Consider an investor parting ways with a declining tech stock before it becomes a financial black hole.
Applying this temperament involves emotional control, strategic thinking, and a dash of courage to ensure your investment portfolio produces above average returns over time. Being the truth seeker in value vesting is akin to being a financial detective, driven by a curious mind, eager to uncover the real story behind those numbers. This concept involves a relentless pursuit of facts, a habit of questioning assumptions, statements, and figures, and a genuine desire to understand the narrative that's concealed within the financial data. In value investing, the truth-seeking mentality is crucial for making informed investment decisions. It's not merely about accepting reported numbers at their face value. It's about digging deeper to discern the actual health and potential of a company. This approach is applied across various aspects of value investing, from scrutinizing financial statements to evaluating management's integrity and assessing the competitive landscape.
Truth-seeking is a timeless principle employed by legendary investors like Warren Buffett and Monish Pabrai. They are celebrated for their ability to cut through noise and identify investments with solid fundamentals. For instance, Buffett's scrutiny of a company's intrinsic value and long-term prospects goes beyond surface-level metrics, emphasizing a holistic understanding of the business. To apply this concept, one might analyze a company's financial statements, scrutinize management's track record, and assess trends in the industry. For instance, if a company reports consistent revenue growth, a truth seeker would investigate if this growth is sustainable by examining factors like customer retention rates or the competitive landscape.
In essence, being a truth seeker in value investing is about going beyond the obvious, challenging assumptions, and uncovering the authentic value of an investment. It's a mindset that recognizes that numbers alone may not tell the whole story, and a deeper investigation is necessary to make sound investment decisions. Investing in the S&P 500 is often endorsed by luminaries like Warren Buffett, John Bogle, Peter Lynch, and Monish Pabrai. It's a strategy rooted in the concept of index investing and passive investing. This approach involves buying a broad market index like the S&P 500, which represents a diverse range of companies.
Historically, the S&P 500 has delivered solid annual returns, averaging around 10% if you factor in dividends. This consistent performance is one reason why value investing experts advocate for it. The index provides exposure to the overall market, and that reduces risk associated with individual stocks. Choosing the S&P 500 over stock picking is grounded in the belief that many investors struggle to consistently outperform the market. Active stock picking requires deep knowledge, research, and often involves significant risk. The simplicity and reliability of the S&P 500 make it an attractive option. Compared to mutual funds, the S&P 500 index funds or exchange-traded funds often outperform other funds due to lower fees associated with index funds and ETFs. Also, it offers better liquidity and transparency. Contrast that with bonds. With equities, potential for higher returns in the long run attracts investors seeking growth. This strategy is applied when building a long-term portfolio, suitable for investors with a horizon of several years. Applying it involves investing in low-cost S&P 500 index funds or ETFs. For instance, over the past decade, a substantial percentage of actively managed funds failed to surpass the S&P 500's returns. Choosing the index is not just a simple strategy, it's a recognition that, for most people, consistent success in picking individual stocks is elusive, and the broader market offers a reliable path to long-term wealth accumulation.